Well, hello everyone. Welcome to the last Monday in September. Fresh new trading week is upon us. Today is brought to you by the number 3. Can you tell I'm a fan of Sesame Street? So today is brought to you by the number 3. We're going to look at 3 stocks where we had done previous trades, actually 6 trades on 3 stocks. And those have 5 of the 6 have hit targets. So we're going to look at those. We have 3 example trades that are underwater. They are all short put verticals. So we got a little bit of trade management to do on those. And then we're going to look at 3 new example trades on 3 stocks, not new stocks, but 3, new to us today in our example portfolio, and 3 different trading strategies. So 3, 3, 3, and 3. It's a bunch of 3s going on today. So I want to thank you just as we get started. There are so many of the usual suspects here, but if you are brand new, please type a greeting into the chat so we can welcome you. We have the privilege of having Mike Fairborn with us in the chat. He's a friend and a fellow coach and understands all of this stuff that we're covering today. And we got a lot to cover in our 45 minutes. If you aren't following Mike on X, you're missing out. Mike Fairborn, CS. You'll want to follow me also. Just know that none of us will ever reach out to you and offer a Bitcoin or a crypto deal, private education for a fee, or the opportunity to have us trade your account if you would only give us your password. These are all thieves and scammers, so don't be misled. But thanks to Will and William and Josh and Janelle and Robert and the rest of the gang, to Bill and Sharon and all of you for bringing this class to life by being so participatory in the chat. And if you're watching this in the archives, hello out there to you as well. If you want to type a comment in, whether you love the class or you have a question, know that I do look at those on the daily. Okay. So without further ado, know that options carry a high level of risk and aren't suitable for all investors. You also have to apply for option trading privileges with Schwab, and not all will qualify. We use the Paper Money software application on the thinkorswim desktop platform. Say that 3 times fast. Looks like, smells like, feels like real money. A great place to learn, to become familiar with the trading platform and the strategies you want to master trading. But know that there are some nuances and differences. And one we're going to talk about in our trade management today in particular is that short options will never be assigned early. Okay. So, but that can happen in a live account. And have I seen it happen? Yes, I have. So at the market open, Kevin Horner did a great market overview this morning. So I am going to be very skinny on that. We're going to spend most of our time today in these 2 categories, managing existing trades and placing new example trades on our Paper Money platform. One quick announcement is that Kevin Horner and I, along with Ben Watson and Scott Thompson, who is now teaching one of our classes during the week. In fact, I think he teaches Monday. So either he taught the last class or he's teaching. I think he taught the last class. But we will all be heading to Chicago on Friday for the Saturday market drive. It's not too late to register and join us there. We'll have the coffee on. We'll provide breakfast. We'll provide lunch. And a really nice reception at the end of the day. So we'll feed both your mind and your body. And we'd love to have you on board for that. Following that, there will be a 2-day event in Orlando, followed by another market drive in Anaheim. Okay, so if you've never been to one of these, they are complimentary, so free. There's a 4-letter word that I like. They are free to attend. We'll even pick up the tab for your parking. Okay, you just have to register and get yourself there. All righty. So let's get out and have a look. And let's go kind of back and forth. So if we come to our monitor tab, we can see that we had 2 trades on Take-Two Interactive, TTWO. And so, and we did a stock trade where we bought 20 shares of stock, because this is a pricey stock and we have like almost 32,000 in this example account. But our max position size is 5,000. So hence the 20 shares. And then we bought a call. And this was a little outside our snack bracket in that it was 760. And how much could we have lost? We could have lost all $760. Typically, we like to be in that max loss of $500 range. So, this was an expensive one. And we did a Fibonacci target on this. And the goal was to compare it to the stock position. So this was a little note we put in for ourselves. So if we come to our account statement and we type in TTWO, so here's this trade. We placed it on the 15th. So, about 14 days ago. And today it hit our target. And so if we look at these two, and let me just bring up my drawing tool here. So if we look at our long call to start, and if you missed this and weren't following along, you can go back to the class on the 15th and check it out. But so we ended up out today for 760. We did one contract. How come we only did one? Well, because we were we were out for 760. We were in for 520. That's why we did this. I was thinking, I'm surprised we actually did that trade because I don't normally break that rule to that degree. And I didn't. So there I go. I could throw my shoulder out for patting myself on the back. So how much did we make on this? Well, we made $240 less our transaction fees. It was 65 cents to enter the trade and 65 cents to exit the trade. What was our return on risk? Well, how much could we have lost? We could have lost that whole 520. So I stand corrected on that. And how much did we make on it? 240. And so we're going to divide that by the 520 that we were risking when we placed the trade. And that came out to a 46% return. And our expiration date was December, and we don't normally go out that far. So why did we go out that far? We went out that far because, we had a Fibonacci target that we knew might take a little longer to get to. And then our stock position, let's just do that in a different color because it's Monday and I'm feeling optimistic about my drawing tool. And so we got out for $258.46, so almost $10. And we got out of both of them today. And then $248.89, so that's $9 and change, right? How much change? I did the math ahead of time, $9.57. So here we made $9.57 per share times 20 shares. And so we made $191.40. And what was our return on risk? Well, we take the $9.57, divide it by the $248.89, which is what we paid to get in. Now, we did have a stop loss in place, but technically, and we had a stop in place for this one also, but technically it could have gone to zero. So our return on risk, or you might want to call it return on our investment, because we were investing $248 a share, it was 3.8%. And so if you look at this, you could say, well, hey, we made less on the stock, and because we made $240 here, we made $191.40 here. This was a 3.8% return. This was a 46% return. So obviously long calls are better. Well, not always. Like, what if it had kind of gone sideways and come December, it was still trading around 290? Well, this would have expired worthless if we hadn't exited the position ahead of time. We would have been out $520. And if it was, say, sitting right at 290, we would have still been up on our position because we paid $248 for the stock. Now, why did we, when it was trading at $248, why did we go all the way out to $290? Like that's a way out of the money call. It's because we didn't want to break our position sizing rule that said we couldn't risk more than $500. So obviously, if we go out and look at December options now, well, the stock has gone up, but you'll see that the at the money options probably weren't in our snack bracket. In other words, they were too expensive and we would have had to take too much risk. So TTWO. If we came out to December, see the at the money strikes. And I know that the stock has gone up, but the at the money strikes over $1,000. So that's why we came out to something that was more out of the money. Okay. So Will, you are forgiven for being late, but on a Monday, whew. Okay, I'll give you one pass this week. Okay, so now let's go look at something new. Okay. So let's go to CrowdStrike. And let me just take two. So we've done take two. Okay, so we're going to look at CrowdStrike. So, and you know, I wanted to talk about the news today because for the new positions we're putting on, because these are all news related decisions. So one, I looked at the chart and went, oh, this is interesting. So, you know, we have a stock that's up almost 40% year to date. And if we come and we look at the S&P, you know, it's close to an all-time high, hit a new all-time high last week. Same with the NASDAQ, it's up on the day. How about our small caps? You know, okay, it's down by a smidge, but the day is young yet. But, you know, it too hit a new all-time high. And then the Dow, which I did a thing like 5 things you may not have known about the Dow that I posted Friday on X. You may want to go check that out. But it too, you know, pulling back by 43 cents today, you know, but that too, you know, obviously still in an uptrend. Okay. So, you know, things are kind of ticking along here. But when we come to CrowdStrike, so this is on the 25th, so on Friday. Let's have a look. So Friday, Scotiabank raised their price target to 600. Where is it currently trading? 487. Okay, Canaccord raised their price target to 500. I just find this interesting. So this is what these guys do for a living. And one is at 500, Scotiabank's at 600, and they went from 440 to 600, JMP Securities 550. So there's a pretty wide range, but what is common is that they're all raising their price targets. And, you know, today, you know, or Friday, you know, we had Scotiabank hit the crowd as well. And when we looked at this, we have a bullish engulfing pattern here on the chart and then followed through again today. And so could we look at maybe doing the same thing, kind of thing that we did with Take Two? You know, like we couldn't buy many shares, but we could buy 10 shares. That would be 48.60, you know, to replace the Take Two trade that we got out of, and then put in a target around 505. You might say, well, we wouldn't be making much. Well, you know, let's see, how much could we make? So if we go to our calculator and say, okay, if we got out at 505 and we're buying in at, let's just round it to 487. Oops. 505 minus 487. What the heck? 505. I can do this in my head faster. Minus 487. $18. And you might say, well, okay, if we divide that by our 487, that's a 3.6% return. But how long are we planning on being in this trade? You know, like maybe a week, you know, maybe 2, then we could end up stopped out. So where might we put a stop? Well, we might say, well, hey, this recent low here 469, what if we went 2% below that? So I'm going to use my calculator because obviously using this one on Thinkorswim, I seem to be a little challenged. So what did I say? It was 469 times 0.98. So we're going to put our stop at 459.62. 459.62. And so how much are we risking? Well, so 59, 69, 79, 89. If it's $30 a share, it's 300. You know, we don't want to risk more than 500. So we would be within our parameters, right? So let's come to the trade tab. Our target is going to be 505. That's our target. Looks like we did a long call vertical here. I thought we had talked about this. And on Friday, when we did this, you know, we looked at it and we said, well, this doesn't require confirmation because it was a bullish engulfing, you know, if it in fact closed out the day there. So we are going to buy custom with an OCO bracket. So that means we're putting in both a target and a stop. And I'm going to close this because we're going to change this to 10 shares. And then we're going to hit our little firecracker and turn it into a paper clip, which will even out our quantities. And we're going to make this 505. And 459.62. And so with this, what are we looking for? You know, a base hit. We're looking for a base hit. We're not looking for a grand slam here. Now, you know, and this is a swing target. And so, you know, we bought it at 488. Oh, I wonder why we got, it's saying our ask price is 487.20. In any event, we're into this trade, and with 10 shares, we're under 5,000, and we're risking less than 500. Although with stops, there's no guarantee that you're going to get out at exactly the price requested. Now, if we wanted to come out to November and buy a call, where would we have to look? Like way out of the money. You know, we could do the 520 call. We could afford that. And you might say, well, we're putting a stop in. Yeah, but what if it gapped down? Or what if it goes sideways? Like we could lose this entire amount. And so it's trading at 486. We're going to sell the 520 call. And this has a delta of 23. So if the stock goes up by $1, how much could we, you know, expect to make? About 23 cents. But it's 23 cents on, you know, $5.10. So let's do that and then we can compare. Oh, sorry. I meant to be looking at November. So thank you for pointing that out, AP 514. So here, like to come out to November, like we are way out of the money here. We'd have to come out to the 580. And now we don't have a delta of 23. We have a delta of 14. And so that's kind of interesting, isn't it? But you know what? This is an opportunity for us to learn and say, like, you might be saying, well, why not do the October? You know, because the October is only 18 days. And if we come and look at, so let's look at theta. So what does theta tell us? It's time decay. We're losing on these options 47 cents. Okay, let's come out to the one we were really looking at, this one, 35 cents a day on a $5 option. Like time decay is like chewing the value of this thing up like for lunch. Where if we come out to November and we're looking at what we can afford here, Our time decay is 16, like less than half. Okay. So we're not doing a vertical, we're looking at buying a call. And so we're going to buy a single call. We're buying it custom with an OCO bracket because we're going to do the same thing that we did with the stock. Only, this, we're making both of these good till canceled. And then we're making this a market order to exit. If and when this comes up and hits 505. Now, just so we can do an apples to apples. So sometimes when you're doing a swing trade with a long call, so what some might do is say, okay, I'm going to put in a stop. If it loses half its value, I want to exit. But we wanted to be able to compare these two strategies. So, it may not let me do that. Well, let's do this then. Let's make it, if it loses half its value, we want to exit. Okay. So it doesn't seem to want to let me put this in as a market. Change it. Okay. And then this long call, we're going to compare to the stock position with the swing target. And this is a swing trade. Okay. All righty. Okay, so we'll give that one a minute to fill. Okay, so there's our first two trades, new trades for today that we're going to compare. And they're both swing targets. One is a long call that's way out of the money in November. And then the other one is was the stock. And then we've already looked at take two. Now, the other one I wanted to look at was Electronic Arts. And so let's come and look at the chart. So with Electronic Arts, we did the same kind of thing, right? Where we could compare and contrast back on this date here on September 12th. We had a diagonal resistance breakout. So we bought a long call and we bought shares of stock. And it kind of lollygagged about, didn't do a whole lot of anything. And then we had this inside day. And today, holy smokes, Batman, or Friday, this thing really took off and then it gapped up again today. Now, I'm not quite sure, so it hit our target and you may be saying like, ooh, like this is kind of painful. We got out here. But you know what? We agreed when we placed the trade that this was our target. And we would be happy with the amount of profit that we received, okay? But then news came out, and look at what happened with the stock. It went like nuts. So let's come and look at Electronic Arts. We placed this one on the 12th, and again, we bought 30 shares of stock this time, and the stock went from 170 to 181. And so when we look at our stock position, we made about $10 a share, right? Not quite. Well, actually, we made a little bit more because if we look at our 181, which is what we got out of this for on Friday, and our target was a little bit below that. So there may have been a bit of a paper money fill, but it was pretty close. And we can look at it once I close this drawing tool. But we were up by $10.20 a share. Times 30 shares. So we were up by $306. And so, that's a really nice, base hit, call it a double. And there's no transaction fees with stock to get in or out. Now, what this is saying is we got in for $4.90 and out for $4.90. So on the long call, we made zero. Now, had we stayed in that long call, we ended up at a wash. And I'm not quite sure why, this filled it at this price. Because that seems a little off to me. I don't have a way of comparing it to a live account for this trade, but our target here was 180 and we got out for 181.01, and it was the same target on both the call and the stock. But that's how that one turned out. But if we come to the trade tab and we look at that November 180 call, and let's come back. That November, it's now trading for over $20. But it did, it gapped up again today. It's up another almost 5%. It's up another $9. And so on this one, I'm not sure if, there was a little bit of a paper money fill, because you would have expected the stock to fill closer to the 180, but there may have just been so much buying going on that we got a little better fill. And then again, it's gapping up again today. So the news definitely influencing this one as well. Okay, so that's a review on two. Let's come and look at GFS. So GFS isn't one that we typically look at. And what news is there on this company? Well, GFS, we set up a bit of a, it looks like a bit of a double bottom happening here. This one is under $50 a share. And, I wanted to come over here. So let's look at the news. So lots of news coming out on this company. So Global Foundries, which is the name of this company, and Corning to collaborate to deliver detachable fiber connections. So, this is big news. Global, stock climbs. So this was on Friday. Okay. And we saw the response, and then up again today. Now, when you see candles like this candle is green. Why is it green? Well, it's dark green because I use candle trend, and it means it opened higher, finished lower than where it opened, but still was appreciably, like in this case, higher than the close of the day before. If you have a red candle, it's because it closed lower than, where it opened. But to me, it was still up dramatically. And so I like those candles to show green, but that's just me. And then today we have this pattern that is indicating that we could be seeing a bit of a pullback. But if we wanted to be in this, could we do a buy rate? And we talked about this thought. We aren't placing a trade on Electronic Arts. We place trades on CrowdStrike. Now we're going to GFS. Okay, so we did 2 trades on TTWO. Okay, and now we're going to CrowdStrike. I'm sorry, I'm just responding to questions in the chat. So with GFS, could we look at maybe selling a call at, 37 or 38, or even 40? And what's the volatility like on this company? Well, let's come to the trade tab. It's at 58%. And could we come out to October? Now, we can't sell the 37 or the 38 because it has $5 wide spreads. Okay, so if we look at this and we say, okay, we have 3,700 contracts, over 4 million shares traded today. They're offering 95 cents to $1 to sell the 40, and it expires in 18 days. So if it pulled back, and would we be shocked if it pulled back? No, we would not. But if it pulled back, would we be okay with that? And could we maybe make a buck? Well, or 95 cents or close to a buck. And, you know, so this is, when we do this buy right, we're kind of, we're intending to get into this wash, rinse, repeat. This is going to be our strategy with this. So we're looking to buy covered stock, which means we're buying shares of the stock, selling a covered call. Now, we did a couple of these on Friday. We did 3 of them in trading price patterns last week. And so what's the most we can make? Well, the most we could make is this 40 minus 36.28. So that's what, 372. But if I could make, if you say a trader could make 372 on an investment of 36.28, that smells like over 10%. And it is. Now, what's the probability of that happening? This is saying the probability of it being in the money, only 27%. But if we could make that 95, you know, so if we could make 95 cents on an investment of that 36.25, that's still 2.5% if we were able to buy it back or let it expire worthless and then sell another one. So if it pulls back and we can buy it back for less, like, might that be okay? Now, one of the challenges with this is, where do we put our stop? So if you really want to be in it longer term, you might say, I'm going to come all the way down here to below the 31. But if you say, well, I think this is broken out, I'd expect this 34.50 to hold. So I'm going to put my stop, you know, 2% or 3% below that. So let's put our stop at 34.51 times 0.97. So 3%, 33.47. So we're doing 100 shares. So how much are we risking? You know, about $300. Now, is there any guarantee that we're going to get out at exactly the price requested? Never. If anybody tells you something's a sure thing, run. So we're going to make this a market order. Why a market order? Well, because we don't know how much we're going to have to pay to buy back that call that we've sold. But we're going to say, hey, if the stock goes below 33.47, not going in the right direction, you know, we want to buy this, exit this position. Okay, confirm and send. So somebody's saying, why October, not November? I really like this question, because if we want to do a wash, rinse, repeat, we just as soon like take a little bit of money and ring the cash register, and then kind of have the opportunity. So are we under $5,000? Yep. Most we can make 371. Yep. Read these, you know, orders, warnings at the bottom. This is a buy right. You know, if we came out and sold the 40 here, we get 210, but we're going to be in it longer. You know, we're in it, you know, instead of 1853 days. So if we don't get called out here, and if we get called out, we could always put another trade on. But if it pulls back and we can buy this back, let's say we buy it back for 20 cents and then it rebounds, then we could sell this November one. You know, we'd have an opportunity to put one on in November, but it's personal choice. Typically we look at something between that, like 15 and 50 days. Yeah. Yeah, and Sia is saying, gee, this has high volatility. So one of the things that makes high volatility, that makes it attractive, is that we've got, you know, we've got higher premiums. Okay, so I just wanted to, is it on that we just put on? Was it Devon that was at the top? So we've got APA, BTU. We have a bunch of these strategies on. So let's just look. So APA, now, one thing I want to point out, you'll notice it was in the money on Friday. And some people, if you're newer to this, think, oh, if it goes in the money, you'll automatically be called out. Not necessarily. And we put these on last week. And this one is in the money now, but does it mean you're automatically going to be called out? Well, you're never going to be called out in paper money. You could be, but it doesn't mean that you will be. And you might say, well, I want to be called out. Well, tough nuts. You may not get your wish and be called out. But what you could do is look at this and say, okay, well, it's in the money. If I wanted to cash out, like the most I can make is $26. Right now, I'd receive $24.65. So I'm leaving $1.35 on the table. So you might just say, well, yeah, I think I'll hang in there for a bit. But there's one, okay, so it's Devon that I wanted to look at. Door number 3. So with Devon, we did this buy right on Wednesday. Okay. And then it went way up in the money, and today it's pulling back. But it actually wasn't Devon. But again, like, we're flirting with that, and we're okay with that because the goal on this is to be called out. Oh, it's INTC. So INTC is the one where we said, hey, this has had such a run. If it pulls back, we're okay with it. And this is kind of similar to what we're doing with GFS today, saying it's at a peak. We know it may pull back. And if it pulls back, then we'll buy back the call and wait for it to rebound. Now, it may rebound and it may not, but it looks like it's finding some footing now. So if we looked at exiting INTC, we put this on Friday, we're up $57. What we might say, well, we've only been in this for one trading day. We're going to give it a little time. But that was kind of our thought process behind it. Now, we do have 3 trades that we need to manage. So, and what I find fascinating with this, so one thing I want to say is, be afraid, be very afraid, or just know that you have work to do if you see an in the money and it's in your short put vertical category. So when we look at AVGO, our strikes are at 350 and 345, and this sucker is trading at 332. So it is below both strikes. Now, when you're in the week of expiration, what is one of the concerns is that you could end up assigned. And when you're doing a short vertical, that means, my friends, that you could become the proud owner of 100 shares of AVGO or Broadcom for $350 a share. So that's more than our account size. So then you'd be getting a knock on your door if it's prior to expiration saying, hello, Barb, you need to put some more money in this account because you're kind of in the hole. Or some brokers may, and call your broker, so some brokers might just automatically exercise the other side, but you don't want to count on that. So that could happen. Okay. But what I find fascinating is we're below both strikes. It's trading at 332 and heading down. And yet to exit, it's currently trading at 422. We're not even at our max loss, and we're through both strikes by, over $20. So what we're going to do is come up to our working orders for AVGO and cancel and replace and say, well, we were hoping to buy it back for 32 cents, but that's not happening. So we're going to exit. And this is, a trade that didn't go according to plan. Now, one of the things that you may want to do, is come back and look at this and say, okay, stock up trending, up 40% year to date, gapped up on the last earnings. And then we have this inside day And so the expectation was that likely this 345, 350 would hold, and it did not. So trade gone wrong. Okay, so sometimes you just have to suck it up and do what you need to do. So now it's saying, oh, they want 425. Okay, so we need to, we want to make sure that we are out of this today. So if it doesn't fill, I'll make sure it fills after the class. There we are. So we're out. $75 away from max loss, but it was still, one of the downsides of a short put vertical is that probably wiped out at least 2 successful trades. And this is when you are, patting yourself on the back, because how much could we have lost on this? We could have, I forget what we were paid when we got in, but we had a $5 wide spread. This is why we did only one contract, so that we weren't risking more than that $500. Now, when we come and look at this, short put verticals, Mickey D's also underwater, and we're at 397 on this, and yet we're through both strikes. So again, when I first started trading these, I thought, if it's through both strikes, like we're just out of the water. And again, not heading in the right direction. And we're now out of time. So we're closing it out. And again, we're still $1 away from max loss, but at 245, this one trade probably wiped out 2 trades, right? 2 successful short put verticals. So they tend to be painful. So cancel and replace. And then the third one was Amazon. And so we're going to do the same thing with Amazon. And again, we're through both strikes. And yet, we're not at max loss. But if we wait till Friday, we likely would be either at max loss, or we increase the risk of being assigned, in which case then you would assign the other side, and then you've taken your max loss. Okay, so we didn't get to do review number 3, and we didn't get to do trade number 3. We now have to wrap up. So, on Wednesday, maybe we can have a look at, so Dash was going to be our example number 3, and we're going to look at a long call vertical on that. And we could have done maybe a stock. So, maybe we'll look at this one on Wednesday. And then the other one that we were going to look at today was on semiconductor, where, we are still in the buy right. So on this day, we did a trade with a 1 ATR target, which had hit the next day, and we're still in the buy right. And here's our buy right is at 51, and we're still hanging out with that. So we'll compare these two at a later point. So that's a wrap for this one. So what did we accomplish? Well, we had 3 trades, 3 short put verticals gone wrong that are all expiring this Friday, and we took our lumps with those, not at max loss, but in the neighborhood. They were all losing trades. We reviewed our trades on TTWO that were successful and that hit our targets, and then the 2 trades on Electronic Arts that were also successful and hit targets. And then we placed 2 new trades on CrowdStrike, and then we did a new buy right on GFS. So as we wrap up, please hit the like button. It helps move things up in the algorithm so that more people can find this content on YouTube. It also lets Mike and I know that you thought this was worthwhile. Subscribe to the channel if you haven't done that already. And last but not least, follow us in the land of X, Barb Armstrong CS, and Mike Fairborn CS. So have a really awesome rest of your day. Up next, Mr. James Boyd. You'll want to stick around for that. Take care, everyone. Bye for now.